Hey, in this video I'm going to go over buying a home with different credit scores and different loan programs. So, how does your credit score affect your ability to buy a home, and what different loan programs are available to you with different credit scores? That's a really important question, and if you don't know the answer, stay tuned because we're going to go over all of that. And to break it down quickly, briefly, what I'm going to go over in this video, because I'm going to be going over a bunch of numbers which I'll also put on the video. We're going to be looking at three different credit scores: a lower credit score of around 620, and then a credit score of 640, and then a higher credit score of around 740. And then we're going to see how those different credit scores affect, if you get a loan, your loan repayment, because the higher your credit score, the lower your interest payment. The lower the interest payment, the lower your monthly mortgage payment. And we're also going to go over, down payments of, putting a minimal amount down in a conventional loan of 3%, or putting 5%, or putting 10% down. Because when you use different down payment amounts, it also affects your monthly payment. And we're also going to go over using an FHA loan at 3.5% minimal down, and versus a conventional loan minimum of 3% down. So, we're going to go over all that, and you might be out there thinking, which loan program should I get? How much should I put down? What's the difference between putting 3.5% down in an FHA loan or 3% down in a conventional loan, and which one would be better for me? What's the difference between putting 10% down or 5% down or 3% down, and how does that affect my monthly mortgage payment? It affects it a lot. And so that's what we're going to go over in this video, so stay tuned. It's going to be a lot of information, but I'm going to break it down pretty easily. I'm going to put the numbers, on the side of the screen here so you can look at it and kind of absorb it. And I have to say up front that all the numbers that I use, this video is for educational purposes only. These are not numbers you can literally take to the bank. They're not meant to be that. I'm not a certified lender. I am a certified real estate professional. I'm a licensed real estate agent. And, I have a number of apps on my phone, with title companies where I can get pretty close estimates, of, home values and interest rates and monthly mortgage payments. And, they're good for just educational purposes. And it's going to give you an idea of, basically, what the plan is and what the difference is. But if you want to find out for sure, you have to go and speak to a certified lender, and they're the one that's going to actually give you, really accurate, interest rates and prices and everything. But this video is going to be helpful. It's going to give you a real clear idea of the differences between credit scores, different credit scores and payment amounts, and, different amounts of down payments and monthly mortgage payments. So that's what this video is all about, so stay tuned. Let's get into it. And also, just another disclaimer here, I do have a lot of numbers I'm going to be using. I have them written down here on a clipboard, so I'm going to be looking down at that clipboard during this video to get the numbers for you. So, let's go first of all. Like I said, we're going to be looking at an FHA loan, a minimal down of 3.5%. With three different credit scores: 640, 680, and 740. And for each of those credit scores, we're going to look at what's the difference between putting an FHA loan down at 3.5%, or doing a conventional loan at 5%, or a conventional loan at 10%. So we're going to use those three tiers for each of the credit scores. Okay, so let's get into it. So first of all, let's start with a credit score of 640. That's a lower credit score. And to get a conventional loan, you may be or not aware that you need a credit score of 620 to get a conventional loan. So if you have a credit score of 600, the only loan that you could get would be an FHA loan. You're not even going to qualify for a conventional loan. That's why I've started with a conventional credit score of 640. So you could do either a conventional loan or an FHA loan. Okay, so let's get into the numbers. Let's assume, the average price here in Las Vegas of a home, last year ended at around $420,000. So let's say you're going to buy a $420,000 home. What's your monthly mortgage payment going to look like with different down payment amounts and different credit scores? That's what we're doing here. Okay, so 640 credit score, $420,000 home, and let's go first with the FHA at 3.5% down. Okay, so 3.5% down is going to give you an interest rate of around 6%, but then you have what's called mortgage insurance premium. That's 0.85%. That's going to give you insurance rate of an interest rate of around 6.85%. And if you're not sure what a mortgage insurance premium, here I'm going to put a link above right now where I go into FHA loans, and it talks about all the different things in an FHA loan. So check that out if you're not sure what FHA loans are about. Okay, so what that means is with an FHA loan of a credit score of 640, your monthly payment is going to be around $3,400. $3,400 for, it's actually $3,416. Okay, now the same credit score, 640, instead of doing the FHA loan at 3.5%, let's say instead you go to a conventional loan and put 5% down. So you have a slightly bigger down payment. So in this case, your interest rate is going to be a little bit higher. Your FHA interest rate was 6.85%. This time with the conventional loan at 5%, you're going to have an interest rate of 7.86%. That includes what's called private mortgage insurance, plus a 6.5 interest rate. So that's, you know, when you get a interest rate, basically it's going to be a combination of two different interest rates. It's going to be the base rate, and then it's going to be either private mortgage insurance or a mortgage insurance premium. So those two numbers together give your effective interest rate. So the effective interest rate at a conventional loan of 5% is 7.86%. That means your monthly mortgage payment at 5% down on a conventional loan with a credit score of 640 is going to be $3,532. That's just over $100 more than that you had for the FHA loan at 3.5%. So FHA loan so far is the best one with a 640 credit score. Now let's go to 10% down. If you put 10% down in a conventional loan, your effective interest rate is going to be 7.5%. So that means your monthly payment is going to be around $3,212. So that's actually better than, that's the best one of all three. That's better than the FHA where you put 3.5% down. The monthly mortgage payment was $3,400. I'm going to just round the figures out in general. The 5% down in a conventional loan, you had $3,500, which was $100 more than the FHA, 3.5%. And now the conventional loan at 10%, it drops down to $3,212. So credit score 640. Your number one option there for the lowest monthly mortgage payment would be a conventional loan at 10%. And then the next best one would be the FHA loan at 3.5%. And then the next one would be the conventional loan at 5%. Okay, so that's the credit score at 640. Let's now say you had a credit score a little bit better, 680. Is that going to make a difference? It actually turns out it does. So, you know, hopefully this is an educational video. I know there's a lot of numbers I'm throwing at you, but I'm putting them on the screen for you. And hopefully the point is, you're going to see that the higher your credit score is, the lower your mortgage payment is. And the more down payment you make, also the lower your monthly mortgage payment is. So that's the whole basis of this video, educating you to those options. So we went over 640 credit score. Let's go now to a 680 credit score. Again, let's start with the FHA loan at 3.5%. You're going to have an effective interest rate that's lower than the 640 credit score. So you're going to lower your interest rate by almost 0.5%. At the 640 credit score, you had an interest rate of 6.85 with the FHA 3.5 down. And now with the 680 credit score, you're going to have a 6.35 interest rate. So 0.5% lower, which means your monthly mortgage payment is now about $200 lower. It's $3,280. So by increasing your credit score from 640 to 680 with the FHA program, you dropped your monthly mortgage payment by about $200, or just under $200, not quite $200. Okay. Now, 680 credit score, what about a conventional loan of 5%, putting 5% down? Well, there you're going to have an effective interest rate of 6.9%. When you had a 640 credit score, putting 5% down in a conventional loan, your interest rate was 7.86%. So now we just dropped interest rate by increasing our credit score with a conventional loan of 5% down. We just dropped our interest rate by almost 1%, not quite 1%, but 0.9%. So now your monthly payment with a 640 credit score in a conventional loan, putting 5% down, is $3,271. So that is lower by almost $300 or $250 from when you had your credit score at 640. Putting 5% down with a conventional loan, you just lowered your monthly payment by $250 by your credit score going from 640 to 680. Now let's say you put 10% down. 10% down with a 680 credit score in a conventional loan. You put 10% down, your interest rate's going to be around 6.65. That is, you just lowered your interest rate from when you had a credit score of 640. Your 640 credit score, putting 10% down, your interest rate was 7.5, and now it's dropped down to about 6.65. So again, you almost lowered your interest rate by a full percentage point. What that does for your monthly payment is your monthly payment is now gone down to $2,995. So you dropped your monthly mortgage payment by, again, over $200. So when you had a 640 credit score and you put 10% down in a conventional loan, you had a monthly payment of around $3,200. But now with the 680 credit score, conventional loan 10%, your monthly payment went down to under $3,000. So you dropped it down by $200. So you should be seeing a pattern here, is that the higher your credit score, your monthly mortgage payment drops by $100 or $200. That just from taking our credit score from 640 to 680, we've dropped our monthly mortgage payment by $200 because the interest rate we were charged is less. Okay, now let's do the final one. Let's say we have a credit score of 740. So, you know, that's a difference. We started off with a low credit score of 640. Now we're jumping up 100 points to a credit score of 740. Let's see the difference here. FHA loan, 3.5% down, credit score of 740. That means you're going to have an effective interest rate of around 6.115. When you had a 640 credit score, your interest rate was 6.85. So you've dropped your interest rate down by about 0.8%, and that means your monthly mortgage payment has dropped from $3,400 down to $3,200. Again, you dropped your monthly mortgage payment by $200 by getting your credit score from 640 to 740 in the FHA loan program. Okay, let's go to the conventional loan. Conventional loan, you're putting 5% down, you got a credit score of 740. Your interest rate here is going to be around 6.3%. So you dropped your interest rate down from the 640, your interest rate was 7.8. At 680, it was 6.3, and now at a 740 credit score, it's gone down to 6.3. So you've dropped the credit score way down, and your monthly payment is now $3,100. So you dropped about $100 from the 680 credit score to the 740 credit score, and you've dropped almost $400. That's really big saving. So when you had a 640 credit score, putting 5% down, as opposed to a 740 credit score and 5% down, you just dropped your monthly mortgage payment by $400. $400 savings between a 640 credit score and a 740 credit score. Big saving. Because once again, you dropped your interest rate on your mortgage by over 1%. In fact, by about 1.5% almost. Okay, last one. What about a 740 credit score with a conventional loan putting 10% down? Okay, here your interest rate effective is going to be around 6.2%, which means your monthly mortgage payment is $2,880. That's the lowest figure by far of any. And what that means is, as opposed to the 640 credit score, you just have dropped your monthly mortgage payment by about $400. And when you had a 680 credit score, you dropped your payment by about $100. So there you see it. Increase your credit score. You're going to massively reduce your monthly payment. And if you put more down, you'll also reduce your monthly payment. And so just to finalize, I know there's a lot of numbers I've been throwing at you, but let's just go do a numerical, like top to bottom, $420,000 home. I'm going to say just list these by what's the cheapest to the highest. So the cheapest was the 740 credit score. The number one was putting 10% down. You had a monthly payment of around $2,880, 6.2 interest rate. The number two was putting 10% down actually at the 680 credit score, where you then also had a $2,995, so it's under $3,000 monthly payment. The number three was actually going back to the 740 credit score, putting 5% down, where you had a $113 monthly mortgage payment. Then the number four was putting 10% down, actually at a 640 credit score is $3,212. That's interesting. And then the number five was the FHA loan at a 740 credit score, $3,222 monthly payment. The number six is 680 credit score, conventional, 5% down, $3,271. The number seven was a 680 credit score, the FHA, 3.5% down, $3,280 monthly payment. The number eight was on the 640 credit score, putting the FHA 3.5% down, $3,416. And the number nine was 640 credit score, conventional, 5% down, $3,532. So from all that, listing all those top to bottom, you can see putting 10% down really lowers your interest rate, and you couple that with a higher credit score, you can really get your mortgage payment down. So, from the highest to lowest, you save yourself like almost $700 difference in your monthly mortgage payment just because you had a higher credit score and you put a little more money down. So think about that. I know that's a lot of numbers, but what you could do is just go over that, go over this video a couple times and you'll start to see the pattern. The pattern is really clear. Higher credit score, lower monthly mortgage payment. The more money you put down, it also lowers your monthly mortgage payment. You combine the two, you put 10% down with a higher credit score, you've got a much lower monthly mortgage payment. The opposite's also true. You put less down, like 3% down with a low credit score, you're just going to have a much higher monthly mortgage payment. So that's the basic lesson. That's the takeaway of this video. Hey, I hope that was helpful. That's a lot of numbers I've thrown at you, but there is a point for those out you there who are serious about buying a home. I just gave you a lot to think about. Watch this video once or twice and you really start to see what I'm saying. And just to finish again, these are not hard numbers you can take to the bank. This video is for educational purposes only, but it is accurate in terms of the trend: higher credit score, lower interest rate, lower monthly mortgage payment. More money that you put down, the lower your monthly mortgage payment. Those things are accurate, and you take those to a lender and they'll reflect the same fact. So, hey, if you have a question, which you probably do, hey, message me. Please do message me. I'll try to answer you, and maybe I'll make another video for you. If you have, you want to know, well, what's my next step? What lender can I talk to? Check out the links below. I've got links below to contact me, and I can get you in touch with a lender. I'd be happy to. I don't make any money from doing that. This is just a free service for educational purposes. I love to do that, so do that. And also, hey, if you get a moment and this has been of any value to you, do me a favor, hit that like button, share it on social media, and hit the subscribe button. And thanks for listening to this video.